sijua jamaa. Ayaya. So ingunda. Mother, 4 months.
Hey Wasi, what happened to your leg?
Hi Peter. Hi. Imagine I broke my leg playing footer. Someone tackled me from behind. Lakini I guess it's just bahati mbaya. Looks like I'll be out of commission now for 4 months.
That's too bad, Wasi.
I know. I can't play footer for 4 months. It's a disaster.
Wasi, don't stress. You'll be back on the pitch in no time. You probably have insurance cover, so all you really need to focus on is just to get better and not the expenses associated with your care, right?
Unfortunately, I don't have any insurance. I didn't think I would need it. Dude, Maze, I'm only 24. I'm forever young. Look at these biceps. I have the perfect body. Ow.
Forever young, eh? Well, it's never too late to purchase health insurance. It may not cover the expenses for your leg, but it will protect you in case of a future injury.
Lakini honestly, this whole insurance thing, it's a bit confusing. I'm not sure which one I need and which one I don't need right now. And also, people keep telling me it's a scam, eh?
Wasi, no one plans to get sick or hurt, but most people need medical care at some point. Insurance covers these costs and offers many other important benefits. Remember, the right insurance cover will go a long way towards helping you safeguard your wealth and your possessions. Don't worry, I'll help you sort it out. Insurance is paying in advance for protection from unexpected or accidental loss or damage of an asset or death or injury of a person. In short, you're setting up a contract to help reduce the financial impact and to protect yourself from some type of loss. It's critical for individuals to understand the 6 principles of insurance. Remember, when you do report a loss, the insurer will examine your compliance with the 6 principles before they decide to pay for the loss. Insurance is premised on 6 key principles. Insurable interest. You can't insure something unless you have a vested interest in it. Typically, insurable interest is established by ownership, possession, or direct relationship. For example, people have insurable interests in their own homes and vehicles, but not in their neighbors' homes and vehicles, and certainly not those of strangers. For example, if an individual were able to purchase homeowners insurance for their neighbor's house, it would be in their best interest to burn down the house and collect the insurance proceeds, whereas it would not be in their best interest to burn down their own home. Indemnity. The insurer's job is to pay you enough to compensate, that is, to indemnify you for your loss, but no more. For example, if your house suffers 500,000 shillings of damage, the insurer will indemnify you up to that amount so that you're in exactly the same position as you were pre-damage. Utmost good faith. The insurance industry operates by the principle of utmost good faith. When you take out a policy, you have an obligation to be truthful with your insurer about the value of what you're insuring and the risk of losing or damaging it. On the other hand, the insurer has an obligation to tell you any restrictions or rules that might reduce the value of your coverage. For example, if you're applying for life insurance, you're required to disclose any previous health problems you may have had. Likewise, the insurance agent selling you the coverage must disclose the critical information you need to know about your contract and its term. Subrogation. Subrogation says, when you accept an insurance settlement, the insurer gets your right to sue the third party. That prevents you from collecting twice for the same damage and gives the insurer a way to recoup its losses. For example, if a third party damages your property, for instance, crashing into your car, and you collect from your insurer can then sue the other driver. Proximate cause. Proximate cause is concerned with how the loss or damage actually occurred. For example, if your home is damaged due to flooding, whereas your homeowner's insurance protects against fire damage but not flooding, the proximate cause of damage was flooding, and your insurer will refuse to pay. However, if you prove the proximate cause of the damage was fire, you can collect. Contribution. The contribution principle states that if you can hold more than one insurer liable for your losses, they have to share the loss. If you take out 2 policies on your car, you cannot collect from both insurers. By taking out 2 policies, The individual's intention is to receive more compensation. The principle of contribution requires that the two or more insurers would share the actual value of the loss. Before we discuss the types of insurance, let's address how Kenya is safeguarding the insurance industry. The Insurance Regulatory Authority has a mandate to regulate, supervise, and develop the insurance industry in Kenya. Its primary core functions are to ensure the effective administration, supervision, and regulation of the insurance and reinsurance business, and to promote the development of the insurance sector in Kenya. Formulate and enforce standards for the conduct of insurance and reinsurance business in Kenya. Issue licenses to all persons involved in or connected with insurance business. Protect the interests of insurance policyholders and insurance beneficiaries in any insurance contract. Advise the government on the national policy to ensure adequate insurance protection and security for national assets and national properties.
Yes, I get it. Another government agency safeguarding an industry. But how does this benefit me, eh?
The Insurance Regulatory Authority, IRA for short, has a responsibility to protect policyholders. As a policyholder or potential policyholder, you have a right to get relevant, meaningful, and understandable information before making a decision to buy insurance. Furthermore, the IRA takes consumer complaints seriously and has in this regard set up a unit to specifically receive and handle complaints. The complaints handling process is accessible to all, and information is readily available on the details of making and resolving complaints. Visit the Insurance Regulatory Authority's website to learn more. www.ira.go.ke. To further safeguard the industry, the IRA has established an Insurance Fraud Investigation Unit. Insurance fraud is an attempt to exploit an insurance contract. Insurance is meant to protect against risks. It isn't meant to be a tool to enrich the insured. Remember, all insurance consumers pay the price for insurance fraud. An example of insurance fraud from the issuer or a seller's perspective includes selling policies from non-existent companies. From a buyer's perspective or policyholder's perspective, fraud includes exaggerating claims, falsifying medical history, death, kidnapping, murder, and much more. Fraudulent claims cost insurance companies money, and they often recoup their losses through higher premiums and rates. This leads to thousands of shillings in increases for the average household and makes us all victims. Any cases of insurance fraud or suspected insurance fraud should be reported to the unit. Let's run through a quick example to show you the basics of insurance, how it works, and introduce a number of key terms. Joseph recently bought a car and contacts Insurance Poa to obtain vehicle insurance to protect him financially in the event he suffers an accident. Joseph meets with an insurance agent from Insurance Poa to review what type of insurance suits his needs. They agree on a policy and Joseph signs on the dotted line. The policy is a contract between Joseph and Insurance Poa that states the terms and conditions of the insurance agreement. It details what is covered against loss in the agreement. As stated by the policy, Joseph is required to make monthly or annual payments to Insurance Poa to protect him financially in the event of an accident. These payments are called premiums. A premium is a fee that Joseph pays to Insurance Poa for protection from risks detailed in his insurance policy. Insurance premium payments can be made in person or through your mobile phone. 5 months later, Joseph was in a terrible accident. He wasn't paying attention when he was driving and drove his car into a ditch. Fortunately, he wasn't injured, but his car had major damage. Joseph was able to secure a police report of the accident and submitted his claim to Insurance Poa. A claim is a request for compensation that Joseph sends to the insurance company when he suffers a loss. Under Joseph's policy with Insurance Poa, there was an excess of 22,500 shillings. An excess is the amount of expenses that Joseph must pay out of pocket before Insurance Poa pays for any expenses. It is normally agreed in advance with the insurer and contained in the policy. It is meant to discourage negligence as well as lower the cost of insurance. In Joseph's case, his vehicle repair bills amounted to 160,000 shillings. Joseph was required to only pay 22,500 shillings, and Insurance Poa paid the remaining 137,500 shillings. Joseph was lucky to have insurance. Had Joseph not had insurance, he would be on the hook for the total 160,000 shillings. Many young adults do without insurance because they view it as an additional expense as opposed to it being a lifesaver in terms of protecting their savings in case of such accident. Now that you know the fundamentals of the insurance industry, let's review 5 common types of insurance further. Medical insurance, vehicle insurance, life insurance, domestic package insurance, and education insurance. In addition to these 5, there are other types of insurance plans out there, from travel insurance to business insurance to kidnap and ransom insurance. Medical insurance is insurance against the risk of incurring medical expenses among individuals. The way medical insurance works is you go to the hospital, which is approved by your insurance company. Provide your medical insurance information to the hospital. The hospital will typically bill your insurance company directly. The insurance company will pay up to the policy limit. Anything above the policy limit will be met by the policyholder. It is advisable to purchase both private insurance, which tends to be more comprehensive, and obtain coverage from the government insurance program, the National Hospital Insurance Fund, NHIF. Every private insurance company has an assortment of different plans that may or may not work for you. Most companies are also willing to work with you to determine your needs. In other words, you can have certain areas of your medical insurance coverage cover specific types of medical illnesses. Keep in mind, single-person plans have a smaller variety of benefits and can be more tailored to the person they cover. You can also have family plans that will cover all the people in your family equally. These family plans are usually cheaper than having multiple single-person plans. It is recommended that aside from private insurance, individuals also opt for NHIF. NHIF's core mandate is to provide medical insurance cover to all its members and their declared dependents. For more information on NHIF, visit www.nhif.or.ke. Vehicle insurance ensures that your car is covered against a host of risks like fire, crash damages, as well as theft. A major benefit of having car insurance is that it covers you financially and safeguards you in case of an accident. When people live paycheck to paycheck, there is not much room for emergency situations that cost a lot of money. Unfortunately, vehicle accidents, especially in Kenya, are the kind of emergency situations that can easily drain a bank account. For this reason, it's better to pay a monthly or annual fee that is known and within your budget than to pay nothing and lose everything. If you operate a motor vehicle in Kenya, it is mandatory, at a minimum, to have third-party vehicle insurance. The following are the key features of vehicle insurance. Depending on your unique circumstances, you may or may not need all these features. Third party. Third-party insurance is purchased by the insured, first party, from an insurance company for protection against a third party's damage and/or loss. Remember, this does not take care of the damage or loss to your own car. Comprehensive. Comprehensive covers the car if it's stolen, accidentally damaged, or damaged by a fire. It also covers the claims made by others for bodily injury or harm to their property. Comprehensive coverage pays to repair your vehicle, subject to a separate excess. It's advisable to purchase a comprehensive insurance plan. Life insurance is protection against the loss of income that would result if the insured passed away. Deciding whether you need life insurance can be a complicated process. The decision can be even harder when you're younger. Let's start with the most obvious reason for why someone should invest in life insurance. One is the fact that it can replace your income if you die before your dependents, the people who depend on you for income. Your parents, spouse, and children, and other family members. The amount of insurance that you need depends on what you want it to cover. Look at how much you earn and how many years your family will need to replace that income if you die prematurely versus how much you have already saved. Also look at what items you want to make sure would be paid for, such as university tuition for your children. Advisors typically recommend a policy with a death benefit that equals 18 times your loved one's annual needs. That sounds like a lot. But if a child or parent requires 1 million shillings a year for living expenses, that works out to a policy with a sum assured of 18 million shillings death benefit. Sum assured is the amount that will be paid upon the policyholder's death. With the exception of a few situations, the main type of life insurance you should consider is term. As the name implies, you buy a policy for a set period, anything from a year to 20 or more. Should you die during that time, your beneficiary gets a death benefit on your policy. A beneficiary is the person who receives the benefits that the insurance company pays. An alternative to term insurance is whole life insurance. This is life insurance that will last as long as the insured person is alive, provided the premiums are all paid on time. If your goal is to protect your children, choose a term policy that will give you coverage until your youngest is 23 or so. By that time, kids can support themselves. Domestic package insurance in Kenya is one type of policy that is sensible to have as a homeowner or renter. When you have a loan or a mortgage, you may be compelled to take out some insurance. If you borrow money from the bank to purchase a home, the bank will require the property to be insured. Keep in mind, the insurance a bank requires you to purchase may only take care of your home's structure, not the contents or other personal effects. Our properties are vulnerable to many risks. These include burglary and theft, which have become so rampant, fire, which has the potential to not only turn your property to rubble, but also cause great damage to your personal effects, natural disasters like floods, which occur frequently and are a threat to buildings and other personal effects within them. With property insurance, the insurance company undertakes to meet the cost of repair or replacement of the insured property and valuable possessions in case of loss or damage. Education insurance assists parents to meet the costs of education through primary, secondary, and on to higher learning depending on the type of policy purchased. The policy is typically arranged early in the child's life and is programmed to mature at the time the child is joining school. Buying education policies early in the child's life will result in paying lower premiums. In the event of the untimely death of a parent or guardian who bought the policy, all premium payments will stop. However, the policy will continue and the sum assured will be paid at the time a child is joining school. This guarantees the child's education in the absence of the parent or guardian. Furthermore, those who buy education policies may also qualify for tax relief on the premiums they pay. As you can see, insurance coverage will go a long way towards helping you safeguard your wealth and your possessions. However, keep in mind it's important to buy insurance that you need and buy within your financial means.
Wow, this is great! Now I have more than my muscles protecting this beautiful body. I have insurance.